Michael, I don't want to neglect you too much down the end there, so maybe if you want to talk a bit more about that, and then we'll take the investor perspective as well.
Yeah, I think China is still a market that interests large asset owners, such as the Canadian pension plans and sovereign wealth funds. It's a massive economy to ignore, but there are risks to that market. You have a lot of state-owned actors that can manipulate the market. Same thing as America too. So, but there can be some issues there, and I think the big thing is the geopolitical risk. I mean, we have, it's all in the news, Russia's invasion of Ukraine, the sanctions that happened with that. And so, Russia's locked out of the financial system. We just saw in the news that North Korea shot a missile around Japan. And then we have the bravado of the US, China and Taiwan issues. So what happens if stuff changes? What happens if there is a confrontation there and the portfolios is allocated to China, and all of a sudden, will Europe and US put sanctions on China? And that would have a dramatic impact on asset owners' portfolios. However, though, China, like on our call earlier, it's a tremendous amount of opportunity. There's certain sectors in China that are thriving. The technology space. My daughter one of her friends uses TikTok. That's a Chinese company, ByteDance, right? So that's one very popular example. While some investors are a bit cautious on real estate, right? The real estate developments. So, China is definitely still a very core part. But what we're also seeing is India. I think a lot of investors in the past decade were a bit nervous about India, but we're seeing a lot of institutional capital, the Canadian pension. Ontario Leader just opened up an office in Mumbai, and so there is the Indian government is making inroads. There's the NIIF, which is an infra fund that is luring investors to invest in certain projects within India, toll roads, key parts of Indian infrastructure. And then you have the rising consumer class in India, as well as the banking system there, right? They have a national ID verification system. So that's also attractive for a lot of sovereign wealth funds wanting to tap into that space, whether it's banking or lending. And then the periphery, Indonesia, Vietnam, Southeast Asia, also seeing a bit of wealth fund action, pension plan investment there. But yes, that's why I said, geopolitical risk is one of the biggest concerns. And that'll dial up and down as we see things unfold. So.
I'm sure your daughter does use TikTok, Michael. She's just...
I hope not.
And so, Rich, I know you've actually lived and worked in China as well. Do you agree with Michael's comments and looking at the various different risks within China, and then maybe broaden it to further Asia?
So I agree with Michael's comments, and I think we could add another 7 or 10 things to the list of major considerations around China. And the sum up of that is we think the China weight decision in each asset class, not just public equities, should be an explicit decision for clients. The benchmark index providers, their inclusion factors for China cause a massive underweight against GDP growth. It is the world's largest or second largest economy already, depending on what you think about purchasing power parity. Post-Brexit, it's bigger than the EU as an economy. So I agree with Michael on too big to ignore. You could still end up with a zero weight at the end of your calculus. Their case is after 30 odd years, I first backpacked around China in 1992. After 30 years of just an amazing economic miracle, has the current government leadership in China forgotten how to manage a capitalist economy? And have they knocked entrepreneurship and animal spirits badly by trying to reduce income inequality, by sanctioning companies right after an IPO, changing housing policy? It's not around speculation, it's around ownership. Okay, that's fine, but the housing sector is going to grow with the economy. China's going to post around 3% GDP growth this year. That is a good figure for a developed country. For China, that's the most disappointing growth within our working lifetimes, at least in my lifetime. So but we think in general, most investors at the end of that will overweight. I think the most provocative comment I can make on China is if you're worried about an armed conflict over Taiwan or the Taiwan Straits, going to zero rate in China does not hedge that risk very well. TSMC not being able to ship semiconductors to the rest of the world, that's a global economic risk. It's probably one of the most vulnerable parts of our global supply chain is the dependence of the rest of the world economy on microchips manufactured in Taiwan. So that if you want to hedge that, we could advise on how to hedge it. Going zero in China does not hedge that risk. It's a much more, China mainland is a much more integrated economy, important economy than Russia. I don't want to minimize the scale of the humanitarian catastrophe in Ukraine and what that means, but Ukraine is not home to TSMC or the global chip manufacturing oligopoly.
How could you hedge that?
It's tough, and just not to put everybody in a bad mood, but so my worst conversation yesterday, we've just gotten done putting out a paper on Taiwan, China, which includes the hedging recommendations. But the conversation yesterday was, do we need to model limited nuclear exchange in Ukraine, and how do you hedge that? So we've always put nuclear war in the category of an asteroid strike. There's nothing we can do to achieve our investment objectives if that happens. Now we've got a scenario that we might actually need to model out. I think we do need to model it out. So briefly, you could take an asymmetric approach and kind of collar what's going to happen with global equities. It would be a stagflationary shock of the type we just had with the Russia-Ukraine invasion, but probably a lot bigger, given the size of China's economy and importance of Taiwan and global supply chains. It depends on the nature and severity and length of the conflict. As Kamila said, a crisis isn't one thing, it's a series of events. So what's the response? How needs to go? Those are important shipping lanes right off the shore of China. Japan, Korea, South Korea, these are other large important economies. So how much of the world economy breaks down in terms of trade flows? Japan's not energy independent, almost diametrically opposite to that. If shipping is disrupted for very long, that's a big problem in the world's, I guess, third largest economy now. I don't think it is past Japan yet, unless you back to the
So maybe one comment on, just to put the conversation maybe back on a less apocalyptic note. The concept of another world war, nuclear exchange, I think we're going to have bigger problem than hedging if this is to happen. It's clearly unhedgeable. The way we think about it is really more in the sense of probabilities, right? So maybe that was a zero probability at some point, maybe now it's any number, 1, 2, 3%, doesn't matter. What happens is that when such probability exists, the sentiment around the globe is changing. Every single player is allocating risk more carefully. Volatility is increasing. There are high likelihoods of jumps, gaps, and things like that. So once this happens, then the price of risk is changing. As in, if you were ready to buy 10% return for 12% risk, maybe now 12% risk is going to require 25% return. So really it is that mechanism of once the distribution of probability starts to shift towards more volatility, riskier decisions, companies not really hiring people, not really allocating to CapEx because they don't know what's going to happen, that's the factor into what kind of risks we take. There's some things which are unhedgeable, and the conversation about how to hedge them, it's just impossible. Now, when it comes to emerging markets, I'm just going to bring another perspective. Let's say China is X amount of percentages in the MSCI world, and you decide to be exactly on that number. How you do it, it can result in massively different results. because the index itself is very heavily weighted towards certain sectors, but one can decide to allocate money to managers which are very much not in the index. They're facing the internal consumer, they're facing the EV batteries, they're facing facial recognition industries which are very well developed, very well supported, and China does become a global leader. And that allocation is going to generate massively different results than the index that might look like developed market equity allocation. So generalizing emerging markets in China we find to be a good topic for conversation, but not exactly investable decision. Across emerging markets, we try to be diversified across styles, across concentrations, and that has resulted in a very resilient portfolio on a relative basis, obviously. So it does go back down to the bottom of sentiment, risks, and what's the price of certain levels of return, but also where does certain country have an advantage. To your point, China has terrible sectors, also fantastic sectors. So choices and patience and local managers is really helpful. And same with India. India was actually a very interesting case because it was expensive and became more expensive because internal flows were supporting this market, and they're gonna likely continue to. So that's a dynamic that needs to be understood in order for allocation to work. So sorry for this lecture on statistics and probabilities, but it is a bit of a more, it's easier to sleep this way and allocate in a bit less apocalyptic manner.
Can I add 2 quick comments? So I think you mentioned probability statistics. Human beings overreact to small probability events that they can visualize well and that have high impact. And that's part of the reason why we think China is oversold relative to the US. You mentioned earlier China down 60. The US today is trading 10% above, the S&P is trading 10% above what it was in February 2020, before we kind of realized the world was going to shut down versus COVID. That market peak just before the COVID shutdown and COVID drawdown, when we were all talking about the market was priced to perfection, we had very much lower interest rates than today. We're above that level today, so there's a lot of room for the U.S. market to come down from where it is. And the U.S. has done so well for so long, especially our tech sector, and we're last report 5.2 million more jobs than before. We've got too much underlying economics like this problem. We're worried that we're going to get a recession, but so there's that. So I think. Whether you try to hedge for it or not, it's a conversation that every investment committee wants to talk about China and then move on and talk about India. Some of these country decisions are so big, and the extremes of in or out are plausible at individual asset class levels that you need to go through the discussion.
We have, thank you, that was an excellent debate and discussion. We do have about 15 minutes left, and I want to dive further into some of the risks, but I'm also conscious that you may have questions, and I do want to keep it interactive. So are there any questions from the audience?
Thank you. I thought the initial tech presentation you made very helpful. I was curious about some of the rotational strategies, particularly some of the Middle East funds going from oil towards technology. I think the latest things are SoftBank, PIF. Panels have thoughts about type of rotational and the type of scale strategy.
So, yeah, technology was a big play for PIF and some of the sovereign funds. With the Vision Fund outline, it's worked out so well right now. You can see the news. So, and you can read SoftBank's interim reports on it. Yeah, I mean, I think when money was more easy, then a lot of money went into tech. I think tech is really looking at their balance sheets and all that stuff. But yes, the wealth funds in the Gulf their fortunes have changed. As the price of oil goes up, then and it stays up, then they will have more money to spend on things, and that will play into the diversification. However, a lot of that money is being used towards kind of what we call strategic development sovereign wealth funds. So I mentioned on that presentation the LIV Live Golf Tournament, the PGA Golf Tournament. I also talked about the gaming group that PIF bought. You can go look at also the Qatar Investment Authority, buying renewable assets. So yes, there is a lot of diversification, and that's going to continue to happen. And so those trends, you can almost just see it happening. But looking at the PIF, you can look at their prospectus. I just saw it. I saw that their Blackstone Infrastructure Fund was negative, and the Vision Fund was also a negative return. So those early investments didn't pan out, but they've also made good investments when they, and again, this is public information. If you look at the filings in the SEC, a lot of wealth funds bought the dip in March 2020, right? And the Fed was going to announce that they were going to back the markets. And so there are times when wealth funds make quite a bit of money. But going back to everything, to tie everything in a bow, is that absolutely technology, renewables, the whole energy transition, those are themes that they're going to continue to back.
I could add a point on from a battler's move into technology. So typically when we go into a sector, it's through a large fund investment, and we use that to, for knowledge transfer and to get more information about it. So we went, or Mubadala went into technology with the 15 billion investment in SoftBank, and I think we saw, the valuations from SoftBank's rounds were just skyrocketing, but Mubadala's become smarter over time as it's gained that knowledge, and now it's making investments in tech for like $1 or $2 million, which is, before they wouldn't even look, it wouldn't be worth their time or effort to look at an investment less than 100 million. So I think what's interesting now is you're seeing sovereign wealth funds invested in all stages of their venture capital cycle, so Series A, Series B, Series C. But was the initial move with the SoftBank investment, 15 billion, smart for the tech industry as a whole? I think there was quite a bit of frothiness with such large-scale investment, WeWork, Uber, etc.
I'll just add a couple of comments. So some theoretical and then practical. The consensus wisdom 10, 15 years ago was if you've got a massive amount of national wealth in the ground, oil, copper, natural gas, you invest in you invest the proceeds in a globally diversified portfolio to diversify that risk and create a store of wealth. So Norwegian Petroleum Fund, Chilean Copper Fund, that was the approach. I think what's new is some of the world's biggest energy-funded sovereign wealth funds are also the biggest investors in clean tech and green tech and renewables. Well, why would they do that? It's the asset allocation hedge to the value of what's in the ground getting disrupted by policy. If carbon gets a price, their clean tech investment valuations go way up, hedging the damage to what's in the ground. There's also an argument about if we have a stable glide path to net zero, that's actually better for oil producers than we wake up one day with a big policy disruption, maybe governments don't get that right, and that there's a sudden loss in value of investments they just made. And then the other newer thing is this idea of it's not quite new, but developing your local economy and not just giving subsidies, but really trying to develop local employment opportunities that are not in the energy sector, and that's certainly gaining momentum and being pursued sincerely. I think whatever we think about how that's all working out, I'll tell a quick story. 6 years ago, we had a sovereign wealth fund ask us, what's the most money we could put to work in venture capital and early stage growth, technology investments globally without moving the market? 3 months later, we had another one asked. 3 months later, we had another one asked. Pretty soon, we're up to 6. So you've had this wall of money moving from the sovereign wealth funds to venture cap and early stage growth. We've got the dynamic of unicorns and decacorns, which we might have had anyway, but we've got it. And whatever the value of those individual investments are, we can pick on the Vision Fund rate at the moment, that creates a huge positive economic externality for everybody else. Because every one of those entrepreneurial ventures that fails, there's learning that's captured by that team, whether they're in Silicon Valley or Shanghai or Frankfurt or Tel Aviv, wherever that entrepreneurial team was that got that support, when that venture fails, that learning is captured by the global economy. And the infrastructure investment that's being made also, a lot of my clients would like to look more like Jim's portfolio and have 45, 75% of liquids, have cash flow, have inflation hedging, have all that. Infrastructure is an asset class that gets there, green infrastructure is an asset class that gets a lot of investment. Infrastructure produces huge positive economic externalities. It raises per capita when you get better infrastructure. I wish somebody would fix our toll roads and our airports in the New York area. And investors want to do that, but you get better infrastructure and the whole economy will turn.
I love this a little bit because I love your comment. Already kind of went where I was wanting to hear, but I love the kind of take to. I don't have a number in mind, but the amount of dry power, call it from the last 24 months, that moved into the picture by some of these asset classes is like an all-time high. And so as we go into this L-shape, U-shape, whatever it's going to be, is there any foresight or, like from your perspective, or from an appetite of where you're allocating capital moving forward? Is there still appetite for that as a class as we're going to double down now? Or are we already overweighted in that? And then are we going to basically know that that's going to potentially cause an asymmetric recovery on the back of whatever this 18 months, whatever this flat piece? And so we're just going to rely, equities or some other asset class. I'm just curious from an LP standpoint, also from a strategy standpoint, what your data says where your advisor money is, where you're looking at this.
So the question about dry powder. Now, we do use that in our portfolio, as in we allocate across drawdown vehicles. So we have certain level of commitment, and that commitment gets drawn as certain opportunities come to fruition. And we absolutely believe this is a way to ultimately have ready capital for when opportunities come, because it's very, very difficult to go to an investment committee at times of crisis and ask for any kind of fast decision on anything. You have to be ready to move. So that's absolutely there. When it comes to private equity, so that's a very interesting question. And the way we look at it, it's a number of ways. So as crisis starts to happen, the private equity general partners absolutely need the dry powder, not necessarily for new opportunities, but to support the companies in the existing portfolio. And I believe one of the best trades anyone could have made in 2008, and a lot of them did, was to buy back the debt of the companies that they were owning. That absolutely was the best arbitrage that could ever be made. So when we make a decision to provide credit to a sponsor to acquire a company, their ability to get this company through a crisis, put more money to work, do whatever needs to be done is absolutely crucial. And we need to see something along the lines of easily 10-15% of dry powder that's not going to be utilized for that book to be able to put money to work at the right time. It's absolutely crucial. I cannot emphasize this, how important this is. Because it always comes to happen, and you have to wait longer, you cannot sell, you cannot monetize, no one wants to buy it, and so on. You have to have the money to do it now. When it comes to the new private equity funds that raise a ton of money, that becomes a decision of speed of deployment, right? Because they're gonna have 5 years to deploy, and is that the right time? Is it not the right time? It's hard to tell. It becomes a bit of an overreach at some point.
That's sort of, I should have asked the question a little better. That's what I'm trying to understand. Is like, let's say I raised 18 months over the last 12. I have this pile of capital, fresh capital, and I find but then I run into in my So let's say I pause or I don't get aggressive because I think risk premium is too high or whatever, valuations are out of whack, come down, and I need 12 months through. So now And not from your standpoint, more from the fund. It sounds like, you know, I don't know, express it another way, but I'm just interested.
See, describing a scenario where a private equity fund raised money 18 months ago,
Hasn't deployed a bunch. Now
anything
they're
along the
going
lines of $5 billion, which probably is a good number, it hasn't deployed much, right? And so the question is, are they going to be under pressure to deploy as the investment period runs out? To be honest, there are many outs of this, as in there are many extensions, there are many ways for the LP community to step in and allow for that investment period to extend. But definitely, there are vintages of different quality, because there is definitely this pressure to buy as the period extends and gets to a close. And that can be supportive, but also can be very disruptive to the market. So, unfortunately, that's the reality, right?
Well, that, because, you know, Goldman's $9.6 billion, that's a totally different thing. Andreessen's 10.5 for about 3. Those are huge numbers, though. So momentum capital that we saw this last decade, which got silly, but and it's good and bad, right? How do we not have that happen again? And if we do, is that okay? We just embrace it and just go, this is crazy, you know, that's going to be worth the entire industry times 5 and we're going to do it again. Like, is it just that, like one bump to the next, and so is that important? Because that's, I don't see the dynamic shifting in that recovery. I just don't see the, yeah, sorry.
So the headline comment is, as we look back, 2009, 2010 are shaping up to have been some of the best vintage years on record. So the fact that we may be going into recession, times are tough, all that, if you can find ways to deploy money and stay the course, and that's how most of our clients are thinking about, that's how we're thinking about when we have discretion. Secondly, your comments raise lots of questions about GP behavior. What's the incentives for the GPs? So we're seeing headlines around fundraising is slowing down, you know, LPs are pulling back, GPs aren't out raising, and that's all true to a certain point, but not necessarily reflective of underlying capital flows. GPs will be careful about fundraising if they don't think the appetite's there from LPs, because they don't want to go out and get a smaller fund or fail the fundraising. That's very bad for their brand, very bad for their business. They'll be more careful about capital calls to try to protect their IRR, and then, but on the dry powder argument, we've been hearing that for years, and the in-house teams at a lot of large sovereign wealth funds have been saying to their bosses, the IRRs I'm seeing on my asset class, forward-looking IRRs, are the worst I've seen in my careers. We should keep money in cash. We shouldn't keep deploying. Don't give me the money. And staying disciplined about vintage year diversification has been the right thing to do up until now. So most of our clients are reacting to this by trying to stay the course, trying to upgrade their GPs, trying to put the money to work. And on the dry powder argument, looking at it as well, public and private markets are fungible. And if we get a recession, the strategic buyers, you know, established publicly traded companies that would compete with private equity to own things, including innovative things. You know, you take the two kids in the garage and you take robo advice and put it together with Vanguard, and you get a category killer, or at least that's how you get success on the robo. It's not the robo skin line. That thesis, if some of the strategics are pulling back because they're worried and trying to preserve their quarterly earnings and stay in their seats, well, that's less competition in the private markets, which have been growing anyway relative to the public markets. You know, we have less than half the commerce now in public markets than we did 20 years ago. The Wilshire 5,000, they haven't been able to find 5,000 stocks for years from out there. So,
Thank you, guys.
I just kind of add to that, I think, you know, some of the sovereign wealth funds have been thinking about that actually. Norway's massive, you know, Norway pension fund global, there's not enough stocks, you know, there's not enough stocks to invest into, and then you know, for them, they're a universal owner, they just buy the market, same thing as Japan's GPIF, so they're kind of stuck. And that's kind of another layer that we're looking at, and that's why they're trying to, you know, impact corporate boards, right? Because if you're a universal owner, then the only way to get alpha is to, you know, influence that. But anyways, yeah, I find the private markets interesting because, again, there are surveys and talk to people, they still see those as the best asset classes. But like I said, I mean, there's lots of headwinds, and you know, I think there's incentives on both sides, right? I mean, for like private equity funds, you're, you know, generate massive fee income, right? The more you keep it going. But yeah, anyways, I think, I don't know, I think wealth funds, what Rachel was saying, they need, you can actually have a startup with less money. You don't have to put down a ton on it. I mean, there's technology now, there's servers, all kinds of things. You don't really need to have a lot of money for a startup unless you're really trying to buy that market share very fast. So I think wealth funds will be a bit more disciplined now, given this current environment.
My greatest universal owner, one of the in-house CEOs of a big sovereign wealth fund that I respect the most, said, I have to own the two kids in the garage in the private markets, because if they're going to take down an industry sector in the public markets, I own the industry sector for sure. And I want to invest with them early so that if they become a unicorn or decacorn, they let me put my money to work as they grow. I've got to be overrepresented in that space, because that's where I'm going to get technology disruption in my publicly traded portfolio. And they said innovation is public markets are way past success. Private markets is where you get future innovation.
Yes.
Yeah, good morning. Question back here, just curious on the investor's perspective. We talked about private equity, private capital. What is your take in terms of, I know that your institutions allocate money to the private capital, like the KKRs, Blackstones of the world. What's your perspective on investing in the private kind of a capital subscription space, plus the public market as a public company? Do you invest in both public stock as well as the private side? Just curious, what is the value proposition when, as an investor, you look at, should you invest in the public market if you're already in the private market with the private capital, private big fund sponsors?
I can make comment on this. So from the standpoint of my group, let's take Blackstone as an example. It's a publicly traded company. It also has numerous amounts of closed-end funds where one can put money to work, right? So we don't have exposure at this point, but they're very different decisions. So the decision to invest in equity wouldn't be decision in the group that I'm part of. It's going to be decision about public equities portfolio, which actively allocates to stocks based on their earnings profile. So that may be an interesting name at some point, depending on the fee income and how the buy side interprets that, which is a very interesting topic actually. But on the other side of things, we're a lot more focused on private type assets for the stability, the longevity, the different expertise that we have as a group. So I would say very different dynamics. Actually, the asset managers, their equity is moving as a fast-moving equity, even though the earnings are very slow-moving. So it's a very particular type of equity, but on the private side or any other fund that they manage, it's all entirely different skill set that they do have. So it's possible, but not necessarily a combined thinking from that perspective.
I'm going to pivot your question a little bit. I think what we see large sophisticated funds doing is, rather than overweight relative to market cap investment in publicly traded private equity players, they're building in-house teams to go direct, or they're doing seeding strategies, or they're doing both. And when Jim talked about what they do with farm ground, and you didn't go into much detail today as on prep call, but on prep call he talked about, we know which families are good. When we rent land, we know who's going to deliver a profit. I'm taking the words out of my mouth, but that's, I heard a very strong case there for they have a comparative advantage in-house against third-party commercial farm ground managers. And so that's just a really interesting space, because there are sovereign wealth funds where we think, yeah, the in-house team is just as good as KKR, Blackstone, whoever. And then there are in-house teams where we look at that and say, or we get hired to do governance consulting and say, actually, sorry, you're not there yet. And in this space, there's the poker saying, if you look around the poker table and you don't know who the dumb money is, it's you. there are some funds that build teams up where they're frankly, with what they're paying, and they've recruited, they're kidding themselves. And they're providing liquidity to people with inside information. So that's where we see people playing in the equity of GPs. They're really playing. I mean, they're in there as they want control, or they want a rev share, or they want something serious for that, or and then in some cases they're taking that in-house capability and dressing it up for third-party money or for club deals. And if you want to dress up your farm ground claim for personal money, we should talk.
So we are actually out of time. I think that was quite a nice look from farmland to water poker. We covered a variety of topics. Just one final question for you. Can you please list us for the next event at farmland?
Well, as I said, I think farm ground is a unique subsector of real estate. It's been 7 or 8 years since I've been to a farm auction where a fight broke out, but I actually was involved in one back in my 30s. But cousin had owned some land that, it's a very interesting subsector of real estate, and one that's highly misunderstood. And I think just as a general thesis, those are situations, I've always preferred, where there's either a massive supply-demand imbalance or, a very misunderstood situation. And I think pro sports teams are like that, a huge imbalance in supply and demand. Litigation financing is like that. So I think farm ground is just another one of those examples. It's a misunderstood asset class. And to me, that's where opportunities arise for better yields. And a high percentage of investors misunderstand or don't know how to take advantage of a particular investment thesis. To me, that's where I want to be.
100%. Please join me in thanking
We're now going to take a short networking break, and things are served on the side of the room.
Hey, Winston. How are you? Yeah, good. How's life?
I can personally attest he's an accomplished author on Web3 and digital asset industry. The book signing ceremony is this afternoon. To Winston's right-hand side is Mr. Vadim Kramov. He's a founder and Chief Investment Officer at Edge Capital Investment Management. It is a global hedge fund specializing in digital assets with a focus on DeFi venture capital. Mr. Kramov holds a PhD in economics from UCLA. He's a frequent speaker on financial media channels and previously was a leading member of the investment team at Trend Capital. And he also was an advisor to the executive director at the International Monetary Fund. And then last but not least is at the end of the table Mr. Greg Gigliotti. He's a chief investment officer and founding partner at Extellus Advisors, a New York-based investment management firm focusing on private equity. And where he is the head of the asset management team. He does not specifically focus on the digital asset industry, but he does have a variety of experiences. And he also serves as an advisory board member of Islamic Coin and is a board member at Digital Nation Entertainment and at PowerX Technology. So we're going to introduce a couple of things this morning. We have a variety of topics that we would like to cover, but we would like this panel to be very interactive. So if anyone has questions or anyone in the panel would like to chime in, we welcome that, of course. I wondered how I would actually start today. How do you introduce something about what people refer to as crypto and the digital asset industry? So I just opened my email inbox this morning and I read that Kim Kardashian was fined $1.26 million by the SEC. And the reason for that is not because she did something that could be perceived as illegal, but because she forgot to adequately disclose that she got paid for doing what she was doing. So let me confirm here that nobody on the panel is giving financial, tax, or other advice, and no one is being paid to be here. But so that implies a question, of course, when the SEC is focusing on cryptocurrencies and other digital assets, they are thinking about protecting investors who are seeking to protect their investments and who are treating cryptocurrency as a store of value. That's of course not the only function that a cryptocurrency or digital asset has, because you can also regard a cryptocurrency or digital asset as a medium of exchange. And so that brings me to my first question. When we think about payments in the digital asset industry, for the panel, Winston and Vadim, what is the current state of DeFi infrastructure and how are payments made? And if, Winston, if you can chime in as well, what is Web 3.0 and how does DeFi relate to it?
Yeah, so maybe start with Web 3, right? This concept coming in as a concept for the next future internet or the next computation platform, as compared to internet started end of last century or the mobile internet revolution started 10 years ago. Now, the interesting thing about Web3 is actually two very different directions. When Facebook changed its name into Meta, it's mostly about user experience, right? Like from two-dimensional into three-dimensional immersive internet, right? That's Meta, right? But when the crypto guys talk about the Web3, it is more in the context of a blockchain-powered internet that will have more decentralized nature, and more importantly, provides ownership to the individuals and the creators, right? Instead of in the hands of the big tech companies like Meta or Google, Amazon, so on and so forth. So in this context, right, then we say what's in the Web3? The natural expectation is it will be decentralized. It will be organized by DAOs instead of corporations, like DAO, right? Decentralized autonomous organization, and all the transactions will be empowered by cryptos. That's sort of the starting point. But I think what's make today's discussion very interesting is today crypto has gone into a very diverse direction. You know, it started with Bitcoin and maybe Ethereum, expanded it into smart contracts, etc. Right? But today it's much more diverse. Right? You get into a lot more tokens and protocols in parallel to Ethereum, and then you also get into NFTs, non-fungible tokens versus the fungible tokens. Right? And finally, traditional industries are generating tokens like gaming, right? Like now you start to see play-to-own gaming tokens and so forth. So to conclude, I think at this moment when we think about DeFi, actually you can create a new term like a MetaFi, right? Because you have a variety of tokens, but in order to make them active and interesting, you have to play with their financial nature, and essentially that's kind of the convergence of these variety of tokens. You need decentralized financing of the cryptos, of the NFTs, and the gaming tokens, right, to generate a market. So let's start with this.
Thanks.
Yeah.
Maybe I'm going to just a couple of things, right? If you continue with what you said, there are a number of aspects in crypto that many people don't realize. So it's not just about Bitcoin, right? To be frank, it's also not about Binance, FTX. What we do in crypto is primarily about blockchain transactions that has nothing to do with centralized counterparties, to be frank. So if you look at the whole spectrum of protocols, we call it protocols, or it's a DApp, decentralized application, which is on-chain. There are many of them. So some of them are, let's say, just pure banks, like lending protocols, like Aave, Compound, many others. Some of them are exchanges. There are also insurance companies, right? You can buy insurance on-chain, fully decentralized and transparent. You actually know the balance sheet of your insurance company, right? So they can go bankrupt because you know how much assets they own, and it's fully transparent life, right? So these things don't exist in traditional money. The next layer is clearly gaming, NFTs. That's also a massive and big project right now. And the next layer, payments, right? If you think about it, the current financial system is extremely inefficient, right? You can send SWIFT payments on the weekends, right? You cannot do it at nights. If you're in the US, you gotta like, it's problematic to pay someone in China right now, right? In crypto, it's pretty much instant, right? And it's really fast as well, right? So no restrictions, pretty much, and you see all the transactions as well. So there is a clear blockchain structure that tells you you can trace every single transaction, every single payment that was done, every history of blockchain, right? That's the beauty of it. A couple of things that we want to discuss here is that I'll just give you an example why we think it's important. We never discussed it, but a good example can be, think about a bank, right? So we're in the building of Bank of America, and I used to work for this company. It's a great bank, but if you think about it, right, why don't we think about the world why would you replace a bank, like Bank of America, with a computer program, right? And say, listen, you can increase your deposit rates, you can reduce your lending rates materially, right? Because there is no overhead, and the computer does it for you, number one. Number two, why don't we do the following, that this protocol would give you also equity for a transaction you do, right? So that's the beauty of blockchain. That's exactly how people in crypto do it. They effectively at about 50 pips a year, right? You can borrow dollars at 50 basis points a year. You can borrow those at 50 basis points a year in the world right now. It's impossible, right? About 10%. It's collateralized loans. You can borrow Bitcoin, Ethereum at about 0.5% as well. Very cheap lending rates, right? Fully transparent. You know your counterparty. You cannot default over there because there was automatic liquidations and so on. So this is a new world that says, listen, let's get rid of the banking system, right? Let's make it fully on-chain, fully transparent. And number two, Aave gives you also equity of Aave, basically tokens of Aave that are used as incentives for people like us to participate. That's number one. Speaking about the payment system, clearly we're at very early stages of the whole financial system development over here, right? We just finally started having instant transactions from fiat to crypto, right? So payments are critical. I would say right now in the US, there are two largest banks that are doing it in crypto, two big banks that do it in crypto. This is Silvergate and Signature Bank, right? That have fast systems to put fiat into dollars through Circle, Mint USDC, and then you can do whichever you want, right? So the largest banks are still getting into this direction, right? So this is the first foundation that is taking place to change the whole payment system, right? Because once you switch to digital payments like USDC, you don't need SWIFT, right? You don't need any like complicated systems. You can transfer money globally. You can trace everything. You can trace every single transaction. It costs you much cheaper to do it. If you do it outside of Ethereum blockchain, the cost of transfer is about 1 cent, right? And it's instant. You can send it anytime, 24/7, anywhere in the world, right? So I think this layer is getting better and better. We have about $100 billion invested in stablecoins currently between Tether, USDC, PAX, TrueUSD, and a couple of others which are regulated. And the rest is just gradually building up. So, but it's not
There's a lot to unpack there. But just to ask one question, you cited the benefit of transparency a couple of times,
yep,
which is fairly well known in the market. A lot of people truly believe in the medium that the DeFi represents, but does the panel think that it's there to replace the current banking system, or would we regard that as an add-on to what the current banking system provides?
Yeah, I think from our perspective, the way we see it, currently it becomes a hybrid model. So for example, when we borrow money on chain, the way we do it, we would sign the legal agreements under New York law, with us getting come through the lending agreements, right? And then the lending takes place through a smart contract. So effectively a company in the US would lend you through a smart contract, disperse USDC. It's fully traceable, it's a smart contract, we see transaction is recorded, right? So it's not a SWIFT payment. But we do sign legal agreements, which are, I would say, under the normal US laws. We can do it without the agreements on chain as well through Aave. But if you want to do more complicated things, we see that it's actually easy to trace these transactions. It's easy to report it, right? Everything is saved in the blockchain structure. You cannot change it. You cannot, let's say, fake the documents. It's fully transparent in this respect, right? So it's much easier. There is no human error, for example, right? There is no like manual typing involved in doing like payments to someone, right? It's all done on chain, which say in the blockchain system.
I come at it from a slightly different angle and, maybe think about it from the bottom up. I'm a bottom-up investor. I'm an alpha-oriented investor. Many of you in the room have been my client where I'm finding co-investment or direct investment opportunities to invest alongside you. I'm just at the Token 2049 conference, and I thought one of the best comments there was when they asked this 32-year-old billionaire CEO of a company, what does the next 10 years look like in crypto? And, having been through this massive deleveraging and a horrific year of all these, stocks that got hit, it was a very topical question, and I loved his answer. He said, well, the past 10 years, we were wearing hoodies. The next 10 years, we're going to be wearing suits. And there he was in a brand new suit. And I think that goes back to the question of regulation and transparency. I think there's that sort of this wonderful idea of being decentralized, free, independent, and we're seeing the need for transparency, for regulation, for authorities to be involved in a way that bring trust to the table. And I think the stability in making a lot of these things investable is going to come from a convergence of that transparency and some guardrails around a number of these investments. There are 20,000 coins, currencies out there today. 50% of those are dead. And a couple of them represent 80% of the real value. One of them, the number 8 coin, Dogecoin, was started as a joke. So there's a whole range of what matters and not. As investors, it's hard enough to try and figure out what are the critical things that can substantiate an investment. And I think a lot of this transparency and the government involvement and regulation are going to help tighten these things up so that we can more predictably invest in things through the cycle.
I guess now's a good time for me to chime in. Thanks, Oliver, for the introduction. And thanks to my fellow panelists for setting up the stage quite nicely for what I'm going to say. But I think I just wanted to unpack that a little bit and give a brief introduction about MAS, Monetary Authority of Singapore, because we're the central bank, financial regulator. We also manage the official foreign reserves. And on top of that, we have the mandate to develop and promote Singapore as a financial hub. I thought that context is important to explain our interest in the DeFi and the crypto space. Basically, our interest in this space that we look through from the different lens of the different roles that we play. So my fellow panelists have outlined quite a few key areas already, setting up the stage for what we think the future looks like. And I love the word infrastructure, and because in MAS and in Singapore, we're very excited to grow the digital assets ecosystem. And by the choice of those words implies that there are a lot of players within this space, but public and media attention tends to be on cryptocurrencies, which is quite distracting in my personal opinion. And when you look at ecosystem, there needs to be a medium of exchange to facilitate transactions. And I'll just talk about, there are 3 very popular candidates, right? Central bank digital currencies, CBDCs, and there are stable coins, and there are cryptocurrencies, and amongst others. And I'll just touch a little bit about CBDCs. Different central banks that we know of have all embarked on different stages of exploration on CBDCs. And what's that? They have taken different paths. Some have looked at wholesale CBDCs, some have looked at retail CBDCs. And why do we think they are important? Wholesale CBDCs we see as having huge potential to transform cross-border payments in the current system that's currently expensive, not transparent, and slow. And in fact, I think I would cite a recent report by JP Morgan that says more than $100 billion lost in transaction costs due to the inefficiencies of cross-border payments. So that's one of the pain points that we're trying to solve. And back to the point about it's not innovating for the sake of it, right? We're looking at what are the pain points, what are the problem statements, and trying to solve them. And wholesale CBDCs is one of the more important projects in this space that we're looking at. And other central banks are looking at retail CBDCs, which is just a digital currencies. So CBDCs are a direct liability of the central bank that issues them, meaning the holders of the CBDCs will have direct claim on the central banks. And this is quite important. We've talked about the medium of exchange and how we are seeing this space. And each CBDC project has its own policy goal that will inform the design and the technology choices. For example, what kind of operating model would you like to see? Meaning, should the central bank be involved at every stage in the payment system, or should private firms play a role in intermediating some of these transactions? And for example, should holders of CBDCs receive interest? These are very fundamental questions that each central bank is trying to think about, trying to explore, trying to solve. And choice of technology is not just distributed ledger. It should be a hybrid, it should be the primary engine. So another very important question that we're trying to solve, and I think China has done a hybrid. Some have taken more of that expertise in-house. So very important question that we will hope to solve in the next few years. And then there are stable coins. The value is pegged to another asset. Do we see good potential? Yes, we do, but only on the caveat that if it's backed by very high quality reserves and only if it's well regulated. Currently, there are no international standards as to the quality of the reserves that's backing stable coins, and many regulators around the world are trying to come to some sort of agreement as to see how stablecoin can uphold its promise. And by upholding its promise, it has to maintain the stability of its value. So MAS is also looking at this space. I think we will be issuing a public consultation as to the regulatory approach soon. And we hope to see this space take off and uphold its promise.
Great. Vincent, you want to comment on the DeFi?
Yeah, no, just further on the transparency point, right? A little bit on the separation between cryptocurrency and blockchain, right? Because one part of the quote-unquote transparency is from the blockchain technologies side, right? You do not necessarily need the crypto. And I'll give you an example in China, because China prohibits crypto mining and trading transactions, right? But still, China probably far ahead in in blockchain applications in supply chain financing, right? China being made in China kind of ecosystem, you can imagine lots of scenarios. Let's say a large electric car manufacturer, right? The core enterprises can get very cheap lending, but for the very small suppliers, several layers away, they cannot get a loan very easily. Why? Because they do not get benefit of the whole supply chain ecosystem, right, around that electric car manufacturer. So for supply chain financing in China, there's a big push into blockchain-based SCF, such that all the players in that ecosystem are on blockchain, so the information of the whole transaction can be communicated throughout the system, and the bank can get the information in real time, such that the smallest supplier can also get the cheap debt financing, as if it is the large manufacturer, right? And so when you look at that kind of scenario, the transparency comes from the efficient transmission of data on the blockchain, right? Not necessarily related to crypto.
This is all very interesting, but I do want to ask a few questions about what you all just said. So first of all, as I understand it, so we're talking about how the government is participating in the broader universe of the digital asset industry. We're distinguishing between CBDCs, which is clearly issued by a government, stable coins, which is then pegged to a certain other store of value. That could be the dollar, that could be the yuan, that could be gold or anything else. And then we have any other crypto token. That could be, I guess, that could be Bitcoin, that could be governance token, utility token. We have the use functions, right? So here I think is a good overview of everything where the market is, but part of this market is clearly driven by the government, and part of this market is clearly driven by private issuers, private players. So how do you all see how the government and the private sector collide with each other? How will they survive together? And clearly, like the way that I was thinking about it is that we should think about cryptocurrency. Well, not me, I read this somewhere, obviously. Somebody much smarter than me came up with this idea, but that the fact that money has multiple functions, like the fact that you use tokens, crypto, etc. Like if our normal financial system doesn't evolve, doesn't give these functions that the market requires, then somewhere else a product will pick up on that, and therefore shouldn't governments like step in and work with this new industry? if you have any thoughts on that.
I guess on that point about working together with the private industry, with the private sector, governments working together, definitely. And it's kind of the approach that we have taken as well in Singapore. We work very closely with the financial institutions to see how we can experiment. For example, we have Project Damba. We worked with quite a few central banks on a multi-CBDC platform that looks at enabling faster, cheaper, more transparent cross-border payments. And that's one of the ways we hope to introduce digital assets to improve lives and to enhance financial inclusion. And those are kind of the overarching goals that we have as a government coming in. On cryptocurrencies, not so much, because that's just one part of the whole ecosystem. And although there's a lot of media attention on it, we actually see that as a very small part. And as a regulator, we've gone out and discouraged that trading, the access to cryptocurrency trading for retail investors. Because as a form of money, it's not a good store of value and it's subject to a lot of speculative swings. And we've gone out and just said that it's not suitable for retail investments. I think I'll just pause there and move on to China.
China is another extreme example, right? Because China takes a very bifurcated approach to blockchain and crypto. Because on one hand, it promotes blockchain technology and implements central bank digital currency on blockchain. And in fact, the China probably is the first major economy that has had mass scale testing of CBDC in the real economy. But at the same time, right, China prohibits crypto mining, trading, and transaction. So there's clearly no crypto kind of free market in China. So essentially what you see here is a very different two approach. For the Web3 guys, it's the public blockchains, like the Ethereum, right, plus cryptos, right? And then in China, the government wants to promote centralized digital network. They call it. It could be a blockchain too, but it's a consortium blockchain, right? Subject to supervision plus CBDC. So these are two very different approaches. Now, what's interesting is in the U.S., right? I see U.S. taking quite a similar approach to China right now. If you think about what the U.S. is doing, right? The Federal Reserve is going to research on the digital dollar. And then, as recent as 2 weeks ago, the Treasury Department is calling the Federal Reserve to accelerate that effort, right? And this is a high priority. And then SEC, right, from a regulatory perspective, is taking on a very broad interpretation of the definition of securities to apply to the crypto market, right? And then thirdly, from ESG perspective, right, there's a mining-related laws in the U.S. are also emerging. Right, New York already passed the law. The governor has not signed it to be effective, but most likely will be. And this could be a milestone, for other states or even federal to take on crypto mining from ESG, kind of renewable energy type of perspective. So actually, I see U.S. Taking a very similar approach to China. So it will be very interesting to see what's next. Like when some concrete federal laws will be formed, or it's just all the different agencies in the U.S. taking actions to try to kind of improve, kind of define their territories. But when they kind of work together, research on the topic, actually there will be no real enforcement actions in the industry, and that's a very big question.
Let me add a couple of things from the hedge fund perspective, because there are different groups and different aspects of different tokens that are regulated differently. Well, let's take the first group. These are stable coins, right? So there are regulated stable coins in the US, like Circle, TUSD, Paxos, right? So fully transparent, very clear. Then there is a second group which is called tier 2, like Tether, right? There are a lot of questions about Tether. Do they have money? They don't have money. We've been having these conversations for years right now, right? So these guys are not regulated. They were banned in the US and so on. There's a third group of stable coins, which are algorithmic stable coins. Like Luna, what happened in May, for example, was a complete disaster. Right? It was like $50 billion were wiped out in a week. So speaking about this first group, regulation is absolutely critical, right? So I think what we went through tells you that A, stable coins must be regulated, right? B, non-regulated stable coins, they shouldn't really exist because people can just steal money, right? And what Tether has been doing in the past 15 years, basically lending to Bitfinex and other exchanges, should not take place, right? And I don't think they've been doing it over the past 5 years, but that's has been the history of this, right? Algorithmic stable coins like Luna, right? Well, this is, you can call it Ponzi scheme type of things, right? So they should be avoided, generally speaking, right? So still, people in crypto can do what they want. So I think from the US perspective, I'll just give an angle what's happening right now, right? So the two largest stable coins in the world right now are Circle and Tether, right? Circle is about 47 billion, Tether is about 65 billion, right? Roughly, in total cash value of the reserves, right? There are smaller ones like Frax, TUSD Paxos, which is like a couple bill each. But Circle grew up massively since May after Luna because Circle is the only US fully regulated stablecoin on the planet, right? That's why Tether is massively decreasing. And I think this is the future, right? We'll have regulated stablecoins, you have full going back and forth between fiat to USDC and so on. I think what was actually new for us in the past months or two, there are a couple of banks in the US that you deposit dollars and you have USDC in your account. You can send USDC, you can send dollars. It's fully convertible. For example, Signature Bank is doing it right now through Signet, through Circle. FD Bank is doing the same. You can just send dollars, you see USDC in your account. You can just send USDC, right? Fully is regulated in the US. So this is like one group of aspects. Second layer of tokens in terms of regulations, this is, you can call it utility tokens, you can call it L1 tokens, layer 1 tokens, like Ethereum, Polygon, Matic, all the chains that are supported, right, by these tokens. Effectively, why do you need these tokens? It's very simple. If you execute an Ethereum blockchain, you have to pay for transaction fees, right? To hedge the transaction, put in multiple servers, right? So that's why you need to buy Ethereum just to pay for this, to pay effectively miners or validators in the current stage, right? To hedge the transactions. Well, in this case, the way you should think about it is like, you should think about it as something you need to pay for your SWIFT payments, right? So for SWIFT payments, you want to send euros, you pay in dollars. For SWIFT, you pay in euros, the same thing, right? So these chains are massive, right? So most of the institutional players have invested in those chains over the past few years. So let's say in the world, people still trying to figure out how to classify them as securities, as commodities. I don't think there is any clear classification right now. I think from the US perspective, where we are right now, this is the biggest challenge because we want to have clarity, and unfortunately the United States is way behind from Singapore, from Swiss National Bank, from the United Kingdom, right? I'm not sure if you guys agree, but for us it's always a challenge. We had conversations with CFTC, SEC, and they don't give us an answer. They tell us, why don't you guys read between the lines and ask for lawyers about it? That's what they literally told us once. So this is a big challenge for institutional players to separate, right? So we can trade some tokens which then become securities and then we have fines and so on. So that's why I would say the majority of hedge funds in the United States just say, let's go with securities, fully regulated, from our perspective, but then I would love to have securities laws applied to these tokens, right? So I don't want these young guys just taking decisions behind the scenes and trading inside the trading information, right? Taking money out of my clients. So that's what we kind of want to do, right? And I think this is the future, right? And I think the next layer is clearly regulation of tokenized assets, right? So for example, there are a few big companies in the US like Securitize that are digitized, not tokenized assets. For example, you have a big real estate building, they want to take a loan against it, right? You can tokenize it. In fact, they've been doing it already here for about 7 years, right? They issue tokens on chain, so this is actually a legal right. You can claim property against it, and if they default, you will take the physical property based on the tokens, right? Then you can split it as many tokens as you want. And you still sign the legal contracts, but you transfer the title to the stockholders. That's it. It's pretty much tells you, so when you do this, it's very convenient for early stage guys, right? So when you have, let's say, round A, B, C, D for startups or VCs, you don't know who's involved. Maybe they double sold the tokens, right? Maybe they double sold the equity, especially at early stages at different prices. Here it's impossible. It's fully transparent. You see everything, right? Also, you can split it in multiple layers. You make it more efficient. You get rid of the banks that charge you massive fees in the middle on the investment banking side and do these things. In the US, 100% securities, right? So it falls under the SEC regulations, right? They tokenize it, call it securities, sell it securities, advertise it securities. That's it. That's pretty much how we see it. From the CFTC perspective, there is a lot of things that is like, I would say, not currently regulated. The biggest one is the trading of perpetual futures on the world. So they're prohibited in the United States. The volume of perpetual futures is roughly 50x higher than trading volumes of spot. Let's say if we trade about $500 billion of Bitcoin, Ethereum, and other things, we trade a few trillion a day of perpetual futures on Binance, FTX, everywhere else in the world, except in the US, right? So in the US, they can decide if they are futures, they should be regulated, not regulated, exchanges are not regulated. So this is, I would say, a big chunk of the market, the derivatives market that exists in the world of digital assets, does not exist in the US, right? So this is, I think, a massive gap for us. That's why when we are, let's say, that's why you see many guys like FTX, they move to Bahamas, right? So they have Binance in Hong Kong, they have Binance in the US as a separate entity, right? Completely different volumes, completely different entities, like much smaller sizes here, right, so far. So we need regulations for this. I think it's coming, but it might take a little bit of time.
Maybe real quickly, just, as far as an outlook from a regulatory perspective, as an investor, typically investors hate uncertainty and surprises. We expect a lot more of that from a U.S. perspective. The political environment just doesn't leave us a roadmap to see agreements, any time in the near-term horizon. You look at something as simple as ETFs, and there's no reason why there isn't an agreement on why ETFs aren't an agreeable regulated product in the U.S. It's a political decision right now. And when I get into the opportunity for things like that to exist in the market like Canada or in the UAE, you see other authorities moving a lot faster to make things happen, and so we look for change to happen in the political environments that are conducive to catching up and making things happen and leading the way for the others to follow over time.
Sure.
I think the US faces a risk of talent drain if they can't get the regulation in order. I mean, you're seeing this in Singapore, you're seeing this in the UAE, there's a great amount of developers and exchanges moving there. Why do you think the US is going so slow? Is it lack of understanding, or it's political, or it's too big for them to comprehend? I mean, it seems like if they can't get the regulation in order, institutional investors won't come into this space.
Well, what I was referring to as far as the political gridlock, not too long ago there was a decision made by the court to push regulation from an environmental perspective from the federal and the state level. What right away was brought to us by a lot of the attorneys looking at it from a legal standpoint was what that means is that going forward, most of our legislation, if that's going to happen at the federal level, has to happen with a majority vote. And in the political climate we have right now, it doesn't look like that is going to happen anytime soon in a very clear way. Until the pendulum swings back with a polarized Senate and House mix that we have, legislation is going to happen more at a state level. It's going to happen inconsistently, and it's not going to happen, in a tidal wave. Whereas you look at something like the UAE, and you can have an individual in the government put their finger on the scale and say this needs to happen sooner rather than later. So that's why we see right now that, one of the reasons for this taking a lot of time, at least in the U.S.
How long about it? So a couple quick statements so that my bias is disclosed, and then I want to ask a pointed question that picks up on that. So bias is, I think, the largest single transfer of wealth we've ever seen in humanity is in this space. I think there's a two-person race right now for
there, and that's SPF and CZ. We can debate which one's going to get there first, but I don't think 10 years from now, one of those can be living. And so, you're going to war, but the reality is that the bridge of a $1.5 trillion asset
Okay, hold on 1 second, we're getting your microphone.
Oh, so sorry. So Sam Bankman-Fried and CZ Zhang from Binance. So they're two of the largest exchanges. So, but neither here nor there. The question I have for you is, as an American, and to Rachel's point, like, I don't want to see us lose ground, right? I think for everything that's broken about Web 2 and the internet today, the reality is that the U.S. essentially has helped govern it, right? And there's been a stability from that. And as we look at the splinter net possibilities that are emerging as crypto and blockchain in China and us go to war, to your book, I don't think that's good, right? I don't think it doesn't necessarily matter, but I don't think it's good bias-wise. So here's my question is, I think we're spoiled. And the reality is we have the biggest weapon on the planet, which is the US dollar reserve and the petrodollar. And whether that changes overnight or not, it's not the point. The point is that other countries, from President Bukele down in El Salvador, and the 44 people that went and visited him that no one cares about and the IMF puts under their thumb, basically just said F you and made Bitcoin their reserve currency and put volcano, free energy basically to mine and create their own nodes. And all it takes is a couple more countries that are small that don't matter to do that, to shift the power dynamic tremendously. And we're doing this at the same time that the current system is breaking. And the reality is this talent drain, capital drain, like who wins? So if you're the US, what do you do? If you're pro-China, what do you do? And if you're in Latin America, what's your strength? Because we don't talk about LATAM a lot because of all the obvious reasons, but the reality is when it relates to crypto, it's one of the biggest users of crypto as it relates today. If you go down there, they need it and they want it and they use it. Up here, we think it's a nice to have or a tchotchke. So where do you enter and what's your case for who wins or what they need to do to not lose or to collectively win? Because that's the markets. UAE's doing all this stuff, but who is best positioned and why? That's my question.
Let me start, right? I think this really depends on the government's vision. Like, do they think the decentralization is the direction, or they still feel they have a meaningful currency they want to defend? Right. So El Salvador, to them, it's a very easy choice, right? Because the currency doesn't mean that much. But for China, they still want to compete with US dollar, right? And you can even take on countries like India, right? India still believe they have a meaningful currency, right? So Indians are taking on a similar approach. They tax crypto transactions and they develop a digital rupee, right? So essentially they're saying, we think our currency is still meaningful and we're going to defend our currency in the middle of this digital currency competition. And we want to be part of it, right? And China made it very clear, saying we want to develop the CBDC. Actually, we wanted to be the first one to have mass scale implementation. And in fact, it will go even beyond to compete the supremacy of the US dollars, right? And that's, in China it's very obvious because if you look at the central bank, two arms, right? One arm handles all the foreign exchanges, for which creates sovereign funds, right? They have the safe, and also part of that money goes to CSC, which I used to work at, right? So they deal with the foreign exchange part. Where do they get the money? They get from import-export, mostly from the US, right? And another arm, they want to develop a CBDC, right? Recently they just tested with UAE, Saudi Arabia for a cross-country CBDC payment. And if you think carefully, right, these two parts are very, very much related. If CBDC of China can challenge the existing US dollar system, that means China does not have to hold as much US dollar as before, like $3 trillion, right? And that means they do not need to hold as many US government bonds as before, right? So in the end, it's about the country's vision about its own currency. Do they want to defend its own currency, or they say, actually the decentralized cryptocurrencies are better, like El Salvador?
Any other thoughts? I have some thoughts too, but go ahead.
Why don't you go first?
Yeah, so from the first part of your question, I wouldn't say there's no regulation. I think it's lack of integration of the regulation, right? So the SEC thinks clearly that everything that we talked about today are securities. I'm a tax lawyer. I think of crypto as a commodity, and the CFTC agrees with that. If I would talk to you about, I'm a U.S. tax lawyer, so if I would talk to you about EU taxation, then there it's treated as currency, and you can go on like that. So there's been at certain intervals there's been an effort, at least by certain industry groups, and that's the pendulum that I think you're referring to try to come up with a comprehensive system. I think thus far the U.S. has been lucky enough because of the perception of value of the U.S. dollar. And secondly, the success of stablecoins as they related specifically to the US dollar, right? And then everything that happened in the last 12 months took everybody by surprise, specifically the failure of Luna, right? And so regulators are just behind the mark each time. You can just clearly see that the Biden administration also understood that they need to do something, and they came out with an executive order. And I think the only reason why, and we were involved as well, we were speaking to the IRS and Treasury as well on our end, the only reason why there's been no further regulation is because people are waiting what will happen. And as far as I can see it, the Chinese the same thing, because there's been, yes, they are the furthest involved in the EU1 is the name, I think. But there's still mass scalability on a global scale other than the US dollar system. And maybe you're right, that's a false feeling of comfort.
No, I think you're bringing up really real dynamic. I don't think I'm right. I'm just saying what I see and what I intuit, because I'm a concrete and clouds guy, but I spend most of my time in the concrete bottom up, and I've lived in Estonia, and I've lived in these markets, for the last couple of years, in some time. And in Lithuania, there's $500 million in 2017 raised in Lithuania per capita more than anywhere else on the planet for ventures. And it was in Lithuania, right? 6.5 million people between those three countries, Latvia, Lithuania, and Estonia, like a nothing market that raised $500 million in a year. So that talent goes to where the capital is. And whether the capital stays or keeps investing or not, usually the talent doesn't. That's why Silicon Valley has the density it has, the LP, like once it settles down, has families and gets jobs, it usually sticks around, right? Unless there's something better. So I think those things continue to happen. So the good news is, I don't know how I feel. I think regulators should wait. And at the same time, the problem is compounding at an exponential rate because the coders are still coding. And I'm talking with all the coders, whatever, their projects with each one of them. And I'm agnostic. I can care less who wins. I just want to taste and know who's doing what. And the rate of this stuff coming out and the open source nature of it. Like, there is no Red Hat yet for Web3. We all know what Red Hat sold for, and it was an open source, right? It was $38 billion acquisition. There isn't that. 3 years from now, there'll be multiple. So there's so many ways to play this, and maybe the problem gets worse, maybe it doesn't. But the security risk and that, like, it's super interesting. It's just, I don't know what the answer is. I just think.
Well, let's summarize that it's for now on an ad hoc basis that there's action is being undertaken. And I mean, for sure, from the U.S. Treasury's perspective, they certainly understand the needs that, for example, Vadim's industry is struggling with. Like from a U.S. taxable perspective, can I mark to market these types of assets? From a non-U.S. perspective, a new investor's perspective, can I trade these instruments with a U.S. asset manager and not pay U.S. tax? And perhaps they're not behind, or they're just like behind where they should be. But my feeling is that ad hoc solutions have worked thus far, and time will tell whether that will remain to be enough. But Vadim, I don't know what you want to comment on that.
Yeah, let me maybe add a couple of things from our experience, right? Well, first of all, from the regulations perspective, right? So I frankly think the U.S. is behind because they didn't get on the issue on time, right? We did speak to the SEC, CFTC, and they were just getting new teams over there. I mean, frankly, in private conversations, we speak to them, these guys have no crypto experience, they're lawyers, right? We've had a few cases that we worked with, let's say, together with CIA and FBI, right? And AUSA, for example, they are lawyers who are not experienced in blockchain, right? They're asking us to have legal agreements with others, right? Where is the lending agreement? That's what the question they're asking, right? So that's why enforcement is an issue, custody is an issue, CATs are an issue, regulations are an issue, and many aspects were not together, and that's why they were behind, right? I would say a few months ago. when we had these conversations. On the other hand, just take a step back. Even like a year ago, there was no proper institutional custody, right, for digital assets, right? So in the US, you have basically Coinbase, which is a qualified custodian, right, which became its only custodian. It was supposed to be a big company. It's like no one is trading with Coinbase anymore, right? Unfortunately, right, for various reasons. Number two, qualified custody in the US, which is required by the SEC if you have about 50 mil in assets, this is a problem, right? So, like, if you want to do DeFi, there is no qualified custody in the United States or in the world that can do like a proper qualified custody for, let's say, LP tokens, if you guys know what I'm talking about. It's like your stake position on chain, right? How to do it, not clear, right? There are a couple solutions in Singapore, like Cactus and Matrixport, right? Those guys do it. MetaMask Institutional have some solutions with BitGo, that is qualified custodians here. Everyone else, like Coinbase, Anchorage, they will custody the asset, but you just hold it. That's it, right? There is no blockchain transactions, nothing behind it, right? So this is a big problem. So a year ago, no one even talked about it because there was no qualified custody. There was no payment system. And institutions could not get in because there was no Fireblocks at the level where it is right now. There was no Copper, there was no Circle, for example, back then, that is building its own MPC technologies, right? Over the past 12 months, it all really, really grew up. Now we have qualified custody, now we have proper like cybersecurity solutions. Circle is right now just finished, and the new project, which is effectively a full-blown MPC technology-based system. But I call MPC, it's called multi-party computation. It's effectively your keys of your wallet are split, so the chances of hacks are materially lower, right? So you can't lose it, right? So they are basically, there is no JP Morgan in our business yet. So once you have a form of JP Morgan, that will help build the business. I think Circle is probably one of the companies that's getting there right now in the United States because they're 50 billion, making a lot of money this year just by putting money in T-bills effectively, right? And they're putting the whole infrastructure around it. So they have custody, you have onboarding of fiat, really fast, instant, full invoices, payments for like traditional finance, right? So all these things help, but the regulators look at it and they're like, oh, okay, now it makes sense, the industry is big enough, it's not like we're just trading some NFTs and, you know, monkeys and all these things, right? Which is a very small part of the business, right? They will be catching up, right? When we speak to the guys like the IMF, for example, or the Swiss National Bank, right? These guys are on top of these things, really, really on top of these things. They know what's going on, they know what the loopholes are, but the US has been just lagging because they didn't see initially the value, then they got really behind, and then it's a problem to find qualified people who've been doing it for many years, right? So it's a kind of a slow process. But we know that they're doing it, the same with the Fed, right? So we spoke with the Fed guys as well. So I'll say about a year ago, they hired a lot of people to look into the blockchain. That's why CBDCs for the Fed is also important, right? And CBDCs, frankly, what you guys clearly understand, is it's a fantastic solution to control money because what people don't understand about crypto, they think it's fully decentralized. No, you can actually take Circle token and freeze it. People don't tell you about it, right? But Circle can freeze your assets, basically, by controlling every single node in the blockchain. So they can blacklist it, that's it, right? So some people can do this, like you can do it with DAI, you can do it with Frax, Circle can, Tether can. If there is, let's say, a hack, that's why hackers never use Circle, right? They switch to ETH, gold, alternative cash, right? So that's why all this is controllable, like programmable money, call it this way. You see the transactions, you can fake it, you can hide it, you can pay bribes with this, you cannot pay drug dealers with this, right? But that's why CBDCs like it, right? So you see everything in this case.
The thing on that, I'm sorry, the thing that on that I've been jumping on for years is somebody's going to do a CBDC that solves the zero end of liquidity trap when it comes to stimulus, right? Because that's the biggest problem we have with stimulant. And so whether they bring the cell theory back from way back in the day where they program in expirability and combine and literally create velocity and separate money and currency. Like that, the potential of that to me is one of the most exciting unlocks. If a country does that, if they can figure out their currency can be the money and then the digital CBDC can be the currency, and they can divorce the two using programmable tokenization, then all of a sudden everyone's getting paid and they have to spend it or it goes away. Any stimulus checks get sent and it expires.
That's a topic in China.
Isn't that what China is doing?
That's a topic in China, right? Back to client economy. Actually, if you can monitor all the flow of money, then you can plan the economy, right? bad, for good or
I thought that they also planned on one of their EU1 certificates that they would actually just expire so that you're forced to invest in the new economy.
That's a tough, right? That was not in the central bank of my paper.
There's the whole thread of ethics.
But it shows how it can be an instrument of policy making, and that's maybe the next step. And for the US as well, including collecting tax revenue and the like. People want to go to...
under 50 in this country, we need an electorate that is under 50 and smart.
That's a whole different topic. People want to go to lunch, so let me just ask one final question. So we've not talked too much about sovereign investors going into this space. So what should sovereign investors be on the lookout for? And do you think that, is there something, you've already talked about tokenization of fund interest, real estate assets, but is there anything like a few years ago was the DeFi, last year were NFTs? What's the next big thing, if you can shortly, in a short way, comment on that, each of you, from your perspective?
Well, I think from an investable standpoint, we're still in a world where it's such early days. You have to define whether you're investing or you're speculating, right? A lot of these businesses are in land grab mode, and it's like Amazon in the early days when everybody laughed at them and they were losing money, but what they were out doing was, they were taking market share and they were creating a marketplace. And that's to some extent what is happening, for example, with the exchanges. Coinbase today trades on a $14 billion market cap, not because they're profitable, because they're not, but because last year they had 20,000 institutional customers putting in the plumbing so they could transact, and they would have market share with all those customers when they want to start moving money between each other in crypto instead of through ACH payments. So there are going to be businesses like Circle, like the exchanges, and there are going to be marketplaces that don't exist yet but will be created for remittances and payments between companies. So what we're looking for is opportunities that we can invest versus speculate. Tilt the odds in our favor that it's more of an investment than a speculation. There's going to be uncertainty with regulation and everything. But we're trying to find places where we can see people who are going to own markets, create brands, have trust, and have guardrails around a business so that when investors put capital in, they can do it with a long-term view.
I think from our perspective, we'll see many people will say like NFTs, other stuff. I'm not really a big believer in part of it. It's going to be clearly like a part of this business related to NFTs, which is related to brands like Nike, Adidas. All these guys are involved in it very actively, which is fantastic, right? But it's a very small part of the business. It's a very small part of crypto, to be frank. All this hype that took place in the past couple of years, this is mostly speculation, to be frank. I 100% agree with you that the majority of what I think is behind blockchain, of the future of blockchain, is not about buying Bitcoin, right? It's not about buying NFTs. It's about payment system, right? A global fast payment system, very cheap remittances across all the countries, right? Instead of using, Western Union or banking system, using really fast payments, using stablecoins, right? This is very easily implemented, what's happening right now. Second thing is effectively replacing, like putting your crypto in the same wallet as your bank account or credit card, right? Fully integrating everything. It already partially exists. Many people doing it. You can pay credit cards with it. You can take loans as well, right? So this is just part of the payments. Then the next phase, what you discussed about the supply chains, is about invoicing, right? I think the biggest thing that what I've seen in the past few months is that people say, let's say, I have these invoices that will be paid or are getting paid. Why can I get a working capital loan for this, right? If you use blockchain for this, the bank can verify, give you a loan immediately, right? And blockchain is immune to changes. You cannot fake your invoice. You cannot show that it's not paid. You don't need to wait for it to get paid, right? For the bank to verify it. If it's on chain, you just click on it. There is a private key to open the transaction for this type of invoices, right? But it's already like in the works, right? So this is, I think, the biggest element. The second biggest element that is missing is cybersecurity, right? And the elements related to, let's say, KYC, money laundering, whitelisting of wallets. This is all building up. This is growing. It's a big gap in the business right now. So this is all happening. We already see that a lot of companies doing it, right? Together with Chainalysis, together with MetaMask Institute, and so on. And I think the last component, which people don't really talk about, This is about advertisement and consumer sentiment. So we know a few companies that effectively do the following. So you can literally put a little microchips in Nike shoes, for example, right? And it becomes an NFT, and people register it, and they can trace their consumer preferences, consumer location, because when Nike sells 50,000 shoes to a retail store, they have no idea who's buying it. They have no idea where to advertise. So currently what companies do from the advertisement perspective, you go to Google and Facebook and you target your audiences based on their geographic location, age, and so on. Currently, what people are already doing in crypto, and we know a few companies who did it already together with Nike, Adidas, NBA, they effectively put a microchip in your shoe, then you scan it, you trace the consumer, you know where he lives, right? It's a blockchain information, which is public. And you can trace him. You can trace all his preferences, whichever he's buying. And you can literally target much better than you know that guys, for example, in Miami are buying this type of brand every time. Why don't you just put more advertising going there? So that's going to change the search industry, right? And advertisement industry that we currently have. This is a big thing related to NFTs applications.
And to add to that too, just, areas like the metaverse, for example, are totally inverting the advertising model. Because you can put all this hardware out there to track users, or you can just pick up some data from a metaverse world, and as people are running by a building, there are thousands of users, let's say in a war game, as they run past the building, the guy who runs by it, the data knows, is that a 30-year-old man who might buy a cocktail? That's the advertisement on the wall. Is it a 12-year-old child? Well, maybe they're going to do something for a toy. But they can so selectively curate the data they collect, how they manage it, and what they want to show you and how they interact with you now. This is one of the reasons why, for example, the metaverse is such a powerful platform. Look at what Drive to Survive on Netflix did to the F1 franchise. It brought all of these users that can't show up at an F1 event into that world. And if you think about the fact that you had to go watch Netflix to see that, now just imagine what the metaverse does to bring that to everybody's phone.
Yep. I think from an investment perspective, there's a variety of investable kind of opportunities because we're seeing a variety of token developments, right? It's just that they're a bit risky right now. So when you look at the variety, you start with Bitcoin and then Ethereum and then all the smart contracts related protocols, that's like a one group, right? And then from there you get into DeFi and then NFT, which is a kind of own ecosystem, and then you get into interaction with industries like the gaming tokens. So there's several ways for institutional investors to approach that. First, for private equity growth capital-like investments, right? You have to look at a very concentrated infrastructure. That's kind of ironic, right? In order to be sizable, it had to be these decentralized infrastructure needs to be centralized a bit, right? So if you look at 2022, the largest deals involving sovereign funds, chain analysis, right? It's a blockchain data security company. GIC led the recent 500 million round, and then Immutable, that's like a NFT marketplace, concentrated. Classic is a leading investor in the most recent round, and then for DeFi infrastructure, right? I have an unfortunate case of a Canadian pension fund invested and it went bankrupt, right? So these are kind of PE growth capital size deals. And then secondly, you have a bunch of like VC deals, right? A lot of new protocols are coming up. A lot of new ideas are coming up relating to these kind of new variety of tokens. Whether it's NFT for gaming, like for example, guys want to develop like a music platform that's organized by NFT, such that the creators can get paid more as creators, things like that. A lot of like new VC ideas, right? As I said, it's just risky, but a lot of out there. And then third aspect I think will be very, very interesting. It is about the interplay between the blockchain community, which right now is still a small community, and the mobile internet market, which is a large user market. So if you look at the NFT example, right, brands, luxury started to incorporate NFT in their advertisement campaign, etc., engage in their communities. So this may be like the first time, right, the blockchain community actually goes mainstream through the power of brands. And the gaming tokens almost did the same thing, right? Incorporate tokens into games, which has like 3 billion gamers in the world. But now it faces pushback because traditional gaming communities say, this is just disrupting the gaming experience, right? not really adding anything. But these are very interesting developments, and at the intersection of the small population crypto community and the large user mobile internet community, you may see very interesting unicorns that come out. So the examples are in the payment, right? If you look at companies like Wire, W-Y-R-E, or MoonPay, these guys managed to bring crypto plays, payment plays onto mobile devices, and that led them to like 10 billion plus valuation. So these are 3 interesting aspects.
It's hard to be the last speaker when these guys are so comprehensive in covering every aspect of what we've been talking about today. But perhaps I will just bring it back in, going back to one of my earlier points about how we're looking at this space, which is innovation to solve real-world problems, to solve pain points that we are facing. And to that, I would just say that we find the most promising use cases in digital assets to be in cross-border payments, to be in trade finance, where there are plenty of inefficiencies that we're trying to solve, and in pre- and post-market capital market activities. So these are kind of the few areas that we see very good potential for digital assets use cases. And to that, from an investor's point of view, I think I would just bring it back to how there might be an overlap with how regulators might be looking at this from a risk mitigation point of view. So as a financial regulator, we kind of looked at it. There was a first wave of risk, which is in money laundering and illicit finance that we're trying to solve and put the rules around that, and as Greg pointed out, guardrails for the long-term investors. And then the second wave as to the cyber risk and technology risk that we are trying to do our due diligence. When someone comes to us for a license application, we're trying to see whether or not they understand the rules and specifically the concepts in traditional finance that still underpins kind of how safety and soundness of the financial system. And then there's the rest of it, which is, for example, protecting retail investors, whether stable coins can uphold its promise, and stuff like that would come in. So I just pointing out kind of the overlap from how an investor might look at it versus how the financial regulator might look at it from a risk mitigation point of view.
Great, thank you all, and enjoy your lunch.
Yeah, sure. All doing good. Good. Yeah. Once we're helping us out, we can be everything you have all. Yeah. He's got a bunch of. Oh, he's doing all. Okay. Okay. Yeah. Sought after. Yeah.
I just wanted to say, you guys have done a hell of a job.
Thank you.
Super stoked
Yeah.
to be here.
Yeah.
I'd love to grab some time during one of the
Yeah.
breaks and just learn how I can help you.
Yeah.
Because I think you guys are doing a tremendous job. So.
We're considering this like whole crypto space when we first did it. I think 90% of it was skeptical. It was like 70%, and then last Austin was like 40% skeptical. Now it's like okay, and so it's a gradual progression of it. I was there. We had our panel. We had Coinbase, we had institutional sales of River, which is backed by Bernard Howard, and then Tim's retirement system. One of those there, but they ended up like hanging out. And they probably made it. Maybe they did a deal. I don't know. But I mean, yeah, this money's not real in that area, so it's definitely slowly but surely. But there's some, blips in the wrong way, like the Celsius flow.
Oh yeah, like all that stuff. It's early days. Infrastructure.
Yeah.
10 years from now, it'll be obvious to everyone who didn't already see it.
Do you think FTX is going to be a big player?
I think, I mean, he can screw it up, but look, the dude's 30 years old.
Yeah.
4 years he's built $30 billion.
But how much actual wealth?
Flowing asset.
How much wealth do you think that guy actually has, or is it cross? Because there's the clubs cross.
So he's got 51% or whatever of FTX.
Right.
Alameda, he owns like 90%. Right. All. Alameda only has money to put. FTX shares a lot of it. So Coinbase has like 100x the number of employees that FTX has, and the revenue FTX I think
What's up Coinbase?
So like he's built FTX and Alameda, and he's got under 50. He's got under 50 that he was working full time. So his ability to write and deploy AI code and trading arbitrage strategies is second to none. So I have no idea how much BTC does that do have?
These are the central bank.
It doesn't take
back here.
too much.
So you're with
Home of the Mighty Panthers.
That wouldn't be my show if that
Well, actually, our family came to the community in the 1830s. She opened in the 1890s. Close affiliation, 5 generations.
And where?
So, do you know where the University of Illinois is? Champaign? 50 mile street.
What's the city called? Charleston.
Walked across the campus every day as a young kid. Yeah, actually, it's fascinating. You don't think about it at the time when you're young. This is like the late 1950s. This is a small rural community, about 8,000 youth. University. They built elementary school to be able to attract faculty. So faculty would come there and say, we've got a great place for our kids to get education. But classes